Hello, friends, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodity sector. My name is Jesse Day, and on today's episode, I'm joined by Josh Young, the Chief Investment Officer and founder of Bison Interests, a company focused on opportunistic investments in public oil and gas equities. We're going to discuss how he sees the oil and gas markets playing out in 2025. The potential impact of Trump tariffs on the energy landscape, why he's especially bullish on natural gas right now, and so much more. So strap yourselves in for my conversation with Josh Young. Josh Young, it is great to have you back on the show, and I'm very excited to be discussing oil and gas markets, something we don't do enough on Commodity Culture. So I want to start off by asking you, what are the main themes and trends you're watching right now when it comes to the oil and gas sector that you think more investors should be paying attention to?
So I think the biggest thing is that there continues to be this consensus that there's going to be very large oil inventory builds, increases in oil inventory globally, and related products. And so I think there's been this very negative sentiment towards oil since roughly, let's say, Q3 of 2022, sort of all the way through the last few years. And so that's been the expectation, that's been the forecast from the EIA, from the IEA, from various investment analysts and banks and so on. And instead of seeing those builds, we've actually seen pretty significant draws. It looks like inventories declined by quite a bit in 2024. They declined somewhat in 2023. And so I think that's sort of the biggest difference in terms of expectations and sort of consensus view versus reality. And I think that's really hurt sentiment. It's really hurt equity valuations. And I think it's been a big driver of the negative funds flow that you've seen both in the futures markets for oil and related commodities, as well as for the ETFs and the individual equities.
Well, what's the reason the market hasn't caught on, given that this data is now out there with these sort of projections that are generally given by the IEA and organizations like that? They've also, if you go back, they get it wrong a lot of the time. What is it? Are market participants paying too much attention to that data and not to reality? Do you think there's some influence of kind of the new green economy agenda and how that has sidetracked people believing that we're at peak oil, we're going to start going to renewable energy, et cetera? What's the reason you think the market hasn't caught on to the facts?
See, that part's harder. I think you can see the data and you can see sort of what the forecasts were and that they've been wrong. And then you've seen these continued persistent forecasts for inventory builds. And again, they just aren't showing up so far. In Q1, we've seen draws, not builds, in global oil and oil products inventories. I mean, this requires some speculation. I think some of it's just that technology stocks and certain other sort of hot sectors are working. And so when those stocks go up a lot, I think people sort of focus on the positives, on the narratives, and the positives on the data associated with that. There's I think a lot of selection bias and attention bias. And so I think it's those stocks and in some cases commodities rising that I think attract sort of a positive sentiment and positive narrative. And oil prices disappointing. They haven't really fallen much in the last couple of years, but they haven't risen. They've sort of traded in a range. I think in the context of this boom in technology and AI and certain other sort of hot sectors, as well as like meme coins and some of the other things that I think have drawn some of the hot money either out of the market or sort of distracted some of the potential incremental buyers of these things. I think that's been a big part of it. And then I don't really know why people would still trust forecasts that are wrong over and over and over again. Like, you can calibrate these things, but people still, for whatever reason, trust the EIA and IEA. And so, I guess a lot of it's also just, again, that attention, where if you're not paying attention to it and you see it and it's from big sort of well-known agency or NGO, maybe you believe it even though you shouldn't, based on their track record.
Hey guys, a quick break to hear from today's sponsor, ARK, Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Yeah, that makes a lot of sense. Well, let's get the cold hard facts when it comes to the current supply-demand dynamics when it comes to oil. What are you seeing at the moment? You mentioned that we've seen inventory drawdowns over the past few years as opposed to builds. How does the situation look at present?
So we're in Q1, which is historically a inventory build season, particularly for the northern hemisphere, because it's winter, but it's also not sort of holiday travel season, and so it's typically a period of constrained demand and plentiful supply. And even in that context, it looks like we've actually seen global inventories continue to decline. I think there's a lot of risk in giving sort of specific numbers on this because there's a wide error band. Frankly, again, you see it sort of in these agencies where they'll forecast like a 1 million barrel a day build or something for Q1, and you're not seeing it, but you don't really know. Again, even looking at sort of the satellite data and all these different data providers and sellers, you don't really know if there's a 300,000 barrel a day deficit or a 1 million barrel a day deficit. What you know almost for sure is that there's not a 1 million barrel a day increase.
Well, I want to talk about some of the initiatives coming from the Trump administration and how they may impact the oil markets. The first is his pledge to drill, baby, drill in a bid to bring down energy prices. Is this plan bullish, bearish, or neutral for oil prices? And is it even possible to ramp up production in the type of meaningful way he's talking about in the US?
I mean, I think it's possible. I just think it's going to be very difficult to do via diktat. I think you're going to need to see changes in fiscal policy. You might need to see changes in tax policy, so like additional tax credits for drilling. You might need to see some of that money that was going towards subsidizing solar panels and wind power and so on getting allocated towards funding drilling in one way or another. Or you might need to see some more sanctions enforcement on Iran and then potentially also on Russia, which is complicated. There's lots of peace talks going on between Russia and Ukraine with various outside parties, including U.S. president and so on. And so I think you need to see something material change in order to get many more rigs active. And one of those things, again, maybe not from a policy perspective, could just be in terms of the market sort of getting a better understanding of falling inventory levels. And then I'm sure we'll get to this, but also higher natural gas prices help induce oil drilling too, because shale oil wells typically actually produce a pretty high percent of natural gas. And so recent low natural gas prices, especially in places like West Texas and Southeast New Mexico, suppressed drilling activity. So higher natural gas prices could also help with that, along with obviously higher oil prices, to the extent that there isn't really a coherent policy shift to actually sort of force or induce additional drilling.
You mentioned the Russia-Ukraine conflict there. We've obviously seen these peace talks occur between the Trump administration and Russia, excluding Zelensky and many of the EU leaders, much to their chagrin, causing them to kind of call their own emergency summit. And they're talking about increasing defense spending now. You've had quite a hawkish tone coming from the Trump administration as well when it comes to Iran. So I guess my question is, if we were to see conflict ramp up, how does that impact the oil markets? I speak to certain people who believe that increased global conflict is going to be bullish for oil prices. I think your take is probably a bit more subtle and nuanced than that. What is your take on whether, if these wars accelerate, we could see higher oil prices, in at least in the short term? What does it look like for the long term for the market? What are your thoughts there?
Yeah, I mean, I think if you don't see material supply disruptions, conflict could increase sort of a risk premium, but I don't think it would necessarily materially affect inventory balances, which is really sort of how prices in the longer term get set. Sort of this larger amount of sort of the actual fundamentals, but also the sentiment sort of drives sort of shorter term and even medium term shifts in price. And so if there isn't a supply disruption that's material, and there isn't a demand disruption that's material, which is a risk, I think, from tariffs, which is, potential trade war is a different kind of conflict, but still possible. Then I don't see sort of a material shift in the fundamentals. That being said, there is a risk of a fundamental shift in terms of, the Trump administration is saying they're going to try to put maximum pressure on Iran, and they've set a goal of reducing Iranian oil exports by 90%, which would be close to 1.5 million barrels coming off the global market between crude oil and condensate. And so, to the extent that they're successful with that, OPEC Plus does look positioned to be able to add those barrels back. Again, Iran is part of that group, but not in the sort of enforced quota portion. And so they're quota exempt. So the quota portion of that OPEC Plus could potentially bring that back to the market to sort of compensate. And where that could still send prices much higher is there's this perception of very high OPEC plus spare capacity. And so to the extent that you have some of that oil come on, I think that would reduce that perception, whether you're sort of in my camp where you think maybe there's 2 or 3 million barrels a day of spare capacity, or whether you think that there's 6 or 7 million barrels a day spare capacity. I think it's hard to argue that bringing another 1.5 million barrels back of that spare capacity would be somehow bearish. Again, if it's just being used to replace other oil that's come off the market.
You brought up tariffs there. I'd like to dive a little bit deeper into that. Obviously, Trump threatening both Canada and Mexico with tariffs, 25% across the board, and then with Canada, 10% tariff on energy. The Canadian reaction has been quite interesting, booing the U.S. anthem at hockey games, boycotting American goods, claiming I'm not going to travel to America. Amusing. I don't think my fellow compatriots are the brightest bulbs in the shed, so to speak. But all of that aside, how much of an impact would that have? Obviously, he's put a freeze on these tariffs for 30 days. I believe the beginning of March is when they will come into effect, assuming that Trump goes through with them. Firstly, do you think he will go through with them? And how much does that 10% tariff on Canadian energy, how much could that potentially disrupt the oil and gas markets, particularly when it comes to the Canadian producers?
So there's a lot of risk in talking about this because, as I understand it, we're having this conversation and there might be a short delay in between this conversation and publication. And in that short delay, there's room for tariff policy to get changed several times. So, I think just high level, the last I saw, the explanation for the Trump tariff policy was reciprocal tariffs. And so to the extent, and not just for Canada and Mexico, but sort of broad reciprocal tariffs with the stated goal of reducing trade barriers globally, along with reducing value added taxes, which is very complicated and really upset people that I think didn't think about it too carefully and look at it too closely. And then also to reduce government subsidies in industries and sort of to offset that. And so I think, with the free market hat on, that's a wonderful goal. Obviously, the devil's in the details and there's a lot of risk. In terms of the specifics with Canada, first of all, I love Canadians. They're wonderful. I don't know if you can see it back here, but I have I Heart Canadian Energy. They call it a toque. It's a winter hat with that logo. So I'm very sympathetic to the Canadians' political plight and economic plight over the past decade of gross mismanagement, which apparently is now consensus. Even the prospective Liberal Party leaders, which is the party that's been in control of Canada for the past decade, are disavowing the policies in some cases they personally were responsible for, and talking about how badly they failed. So I guess that feels like consensus that's been Canadian failure. So it's been very tough, I think, for Canadians. And I'm very sympathetic to this, unhappiness with that, and then the desire to try to find a scapegoat. In a democratic system, if you vote for something, ultimately it's your responsibility. And even if you're in the minority party, if something happens, you still, you're within that system. You voted, your voice was heard, and you're still responsible. And I think people often want to shift that responsibility. And so, I'm sympathetic, but it's tough. How will it happen? Let's say, taking the reciprocal aspect aside, let's just say, hey, 10% tariffs imposed on Canada, on Canadian oil and gas. Honestly, I think there might actually be no real impact to that, because I would expect to see a currency move. I mean, the Canadian dollar is devalued so much already that if you have this sort of thing implemented along with bigger tariffs on other items, you could just see the Canadian dollar devalue by 5 to 10%. And so there would literally be almost zero net economic impact. It would be terrible for Canadians traveling internationally, and it'd be tough for certain materials that are imported to Canada and used in oil and gas development, but there'd be very little impact to the economics of some of these businesses. And actually, since we are talking about that, there are some businesses that trade in Canada but have the majority of their revenue and cash flow overseas. And so if there were to be a situation like that, one, it could actually not materially affect their business operations, but two, it could dramatically improve their net cash flows denominated in Canadian dollars, both in terms of net margins, because their overhead costs and corporate costs would be smaller because they would be measured in Canadian dollars, but then also their revenue and cash flow measured in Canadian dollars would rise if the Canadian dollar continued to fall. So there's actually a group of companies that would be substantial beneficiaries of this sort of setup. And again, 10% tariff, especially if the Canadian government doesn't do anything stupid, which maybe is a big supposition or assumption, but to the extent there isn't a massive escalation, it just stopped at that 10% number you were using. I think almost no impact. And frankly, there's probably a whole set of companies that are pretty big winners on the back of it.
I want to shift to natural gas specifically. You brought it up a little earlier because you actually released a newsletter last month titled All Eyes on Natural Gas in 2025, Bison's Bullish Gas View. You noted that AI data center demand could have a positive impact on natural gas prices, but you stated our bullish stance on natural gas is rooted in a different driver, the rapid expansion of LNG export capacity, which we think is a more immediate and impactful aspect of the demand picture. Walk us through what you're seeing there.
Yeah, so we have two variant views on natural gas in the US. One is that this modular construction process for LNG terminals that both Venture Global and Cheniere have done on their latest facilities is a game changer for liquefied natural gas exports, and could lead to further cost reductions and further speed ups. It looks like the assumptions that the industry is using and that analysts are using when they look at these facilities, that they would take 5 to 10 years to build. Let's pick on Canada for a second. LNG Canada, what is it, 10 years, enormous cost overruns, sort of just gigantic mess, right? You look at Plaquemines, this latest facility from Venture Global, or you look at Sabine 3 from Cheniere, and 30 months from final investment decision to first gas versus LNG Canada, 10 years plus, under budget early for these modular facilities versus way over budget and very late for LNG Canada. So not only does it reduce the cost of these things and speed up the time, it also reduces the risk on the facilities. So if you think about it as an infrastructure investor, and if you're investing for sort of a toll road type setup and returns, if you can do that in a lower risk context, that's going to dramatically reduce your cost of capital and increase your desire to actually invest in those. Whether you're an investor in developers or investor in sort of the final projects, it's going to induce a ton of activity and is very exciting. The one other variant view that we have is that the producers are serious about not ramping up their growth capex until natural gas is $5 plus. We've seen Aethon and Expand, with the old Chesapeake merged with the old Southwestern, which frankly have like 4 other historical growth private E&Ps that were sort of all merged into them in the last few years. they're very serious about it. They just said it at a conference. I got to spend some time with some of the senior execs there, as well as some former senior execs at those companies and some of the next largest ones. And then very recently, Comstock just reported, and they added 2 rigs, which I'll admit my heart stopped for a second, right? It's like, okay, like what's going on here? And then I looked at their production again, and I looked at the analyst reports and the forecasts and so on, and it's amazing. With 5 rigs running, their production was down about 10% year over year from Q4 2023 to Q4 2024. So they're adding 2 rigs back this year. Now they're going from 5 to 7, right? So the narrative is, oh, they're growing, they're adding rigs. And they may not be able to, they're guiding to, but we'll see. They may not be able to get their production back to that Q4 2023 level. Despite adding 2 rigs, despite running 7 rigs, despite only producing, it was like 1.4 BCF a day, plus or minus. I'm gonna get in trouble for doing this ad hoc. I have to go double check. Whatever it is, it's not, it's not the biggest sort of pool of production, and that's a material rig add relative to sort of what the industry has been doing. So those are the 2 variant views. Constrained supply requiring much higher prices than we've seen over the last couple of years, and a much higher forward curve that they're saying, and we're seeing a lot of evidence for it, and this potential acceleration into an already aggressive building boom for LNG export facilities. And so, there's room. The base case is already really bullish for gas relative to the available potential incremental supply. And then our view is this accelerates. The very successful IPO for Venture Global, where they got tens of billions of dollars of value relative to relatively small amounts of equity that they had put into their business, and then Cheniere as well. I think the market's really calling for this, and the ARB is really wide, so there's a lot of room to add a bunch of gas and move that ARB from recently it was $10+ an MCF difference between Henry Hub and TTF, the European gas price, and JKM, the Japanese and the Asian gas price. So huge ARB. 2 things that are real, that are happening right now. And yeah, some of the natural gas stocks are up on the larger side, but a bunch of the smaller ones and the service names and so on are similar levels, or in some cases lower than they were a year ago when natural gas was at $2 and prospects looked a lot bleaker.
Interesting breakdown. I want to talk about OPEC Plus for a moment. There's a tweet from Energy Headline News. They said OPEC Plus considers delay of April oil supply restart, says delegates. Give us your thoughts there. And if you could walk us through how OPEC Plus affects oil markets today and why investors should be paying attention to what they're doing.
So my view and Bison's view on OPEC Plus, I think, is a little different from the consensus. So I'll start with the consensus view, and then I'll share sort of how my view is variant. So the consensus view is that there's millions of barrels a day of spare capacity, and that there's this risk at any given moment of OPEC Plus getting into a price war. You see this in all these headlines. You see many different analysts talk about it. Because of this very large level of spare capacity, there's a view that it's unsustainable, and that there's friction on the edges of OPEC Plus, and everyone knows that running a cartel is quite difficult, especially if you're running this as an oligopoly, as only minority participants, where OPEC Plus accounts for about 1/3 of the global liquid supply, plus or minus, maybe a little more, but directionally that. And so it's very difficult. That's the consensus. And so anytime there's news on OPEC, it matters a lot. And then especially if you use the IEA or EIA global oil glut forecasts, if you're going to have a glut and then you're going to have OPEC Plus adding production, that's where you start to really worry about price war, and where these headlines end up mattering a lot. My view is, and we've shared extensive analysis on OPEC Plus spare capacity and sort of what they might be able to do and what they actually can do. And again, we do think they have some right now. Like I think almost no one thinks there's none today after Saudi Arabia pulled close to 2 million barrels a day off the market versus where they were at. Russia pulled at least 500,000 barrels a day, depending on where you're looking at, maybe more than a million. UAE and Kuwait are down a little. Like there's almost no debate that there is additional spare capacity. But if you're in the camp that it's more in the 2 to 3 million barrel a day range, and again, this might sound wonky, but it matters a lot if it's 2 or 3 versus 6 or 7, just in terms of foregone profits and what the individual incentives are for these producers, producing countries, and what their sort of optimal game theoretic approach is. And so since we haven't seen Saudi Arabia, for example, sustainably export oil indicating production more than, let's say, 10.5 million barrels a day ever, and since we've seen their drilling activity down, and since we've seen their drilling activity shift to much higher cost fields, like very technical, complicated offshore oil fields, drilling much less productive than U.S. Shale gas fields in the middle of the desert where water is an issue and various other things are issues. I think there's a lot of evidence that we're sort of at that low end. So does it matter? Sure, right? OPEC plus cohesion, even in my view, matters. It helps that there's not a couple million barrels a day brought back on the market. But in my view, and I think the consensus view, if you look at what OPEC has done, and the consensus view I think on this is even stronger, their ability to maintain cohesion and pull almost 1 billion barrels of oil out of inventories in the last few years from the post-COVID highs, between oil and oil products and so on. It's pretty amazing that they were able to do that. And even if you thought they had a lot of spare capacity, I would think that would make you want to give them more credit for their cohesion and their ability to have solved this problem, not less credit. So again, does it matter? I think it matters a little. I think the consensus is it matters a lot. And I think we're really going to see what happens when OPEC Plus starts to bring production back as it gets pulled back onto the market. I think later this year, we'll see exactly when that happens. And depending on when that happens, I think you could see oil prices actually rise quite a bit rather than fall as they bring production back on.
Well, we've talked about sentiment in the sector, how it seems to be bearish to muted over the last couple of years. What do you think the catalyst that could change that might be? Is it a higher oil price? Do we need to see WTI at $80 consistently, something like that? Could it be kind of a shift from institutional investors to allocating more capital into the sector, retail investors kind of waking up to the opportunity, or something else, or all of the above? What do you think it's going to take to change sentiment in the oil sector?
So there's a risk of supply disruption, like we talked about from Iran and various other places. I think any sort of perceived increased risk on supply could be helpful in terms of driving dollars into the sector, at least shorter term. I think persistent inventory imbalances drive physical purchases of oil as well as futures purchases by physical market participants. We saw a little bit of that in terms of Chinese buyers of oil futures as well as more physical oil contracts around the start of this year. And I think as you get closer to driving season, you may actually see another wave of that. So that could obviously drive significant dollars because they have been the largest incremental consumer of oil over the last decade or so. And so I think some of it's that, some of it's just hard to know for sure. I guess one thing I'll share that I found interesting running a fund in the space for the past decade, anytime people give up, when they say, oh, hey, like, how is it possible for these stocks to go up, right? Like people hate them so much and they're having good news and, who's the marginal buyer? There's ESG fund withdrawals. There's, just bad sentiment. These other things are doing well. Why would people ever buy this? When I start getting asked that, not that you're asking that specifically, but when I start getting asked that by prospective clients, by existing clients, that's historically been one of the best sentiment indicators that oil and gas stocks are about to go up a whole lot. So we started to get asked that recently, last like 6 months or so, especially the last couple of months, where I think there's just exhaustion. And that sort of exhaustion is very promising, particularly when you consider that oil and gas are cyclicals, right? And they a lot of the production is coming from short cycle investment. So exhaustion leads to less short cycle investment. Less short cycle investment leads to insufficient supply, which leads to much higher price. So essentially, low prices cure themselves via low prices. And you might not think that oil at 70 or gas at recently at 350, now a little higher, is low. But the producers and investors clearly do, because the rig count has fallen 30 to 40% in the US in the last couple of years as prices have fallen to these levels. So I think it's less about what our personal views are, even what our analysis indicates, and more just the observed industry preference and observed industry economics are such that these prices are considered low as expressed by drilling activity, the rig count, the frac spread count, and so on, both on the oil and natural gas side in the US.
So where is it right now when you're looking at oil and gas markets that you are seeing the greatest value proposition for investors who are entering the market today?
I'm finding two areas that are particularly compelling. One is this set of small cap producers that a high percent of their volumes are natural gas, but a high percent of their revenue and cash flow, especially in the last couple of years at very low natural gas prices, was coming from oil and natural gas liquids. And so you have some of them priced at such low levels that they actually have as much upside to improvements in natural gas prices as some of the large cap natural gas producers. But they trade at much, much lower valuations because of that backstop of the cash flow from oil and natural gas liquids. And so in a scenario where natural gas prices rise a lot, these stocks could materially outperform, both because they're cheaper and because they have similar cash flow torque to these larger dry gas producers. In a scenario where natural gas prices were to stay low or go down, they should materially outperform versus those dry gas producers. And in a scenario where that happens, plus oil prices were to rise, they could actually benefit as much from a rise in oil prices as much higher percent oil producers. So there's it's not perfect. There are scenarios where they could underperform, but starting at very low valuations while having significant volumes of commodities that got very little value for multiple years, I think is a great recipe, especially for those that were getting ultra low prices for natural gas in particular at their local basis. So West Texas, you had negative pricing for a big portion of last year. Going from negative pricing to, let's say, $2 or $3 or $4 natural gas is an enormous shift. And people have talked about this a little bit, but I don't think you've seen it reflected yet in those share prices. So that's one category. The other category are the drilling rig providers in particular, and more broadly, some of the services providers onshore. There's been a big shift in value investor dollars and in attention to offshore drillers, which did really well, let's say, in 2023 and have started to pull back in the last, let's say, 6 months or so. But there's been a lot of attention on that offshore drilling cycle, and frankly, a lot of capital that's gone into it. There's been very little capital that's gone into the onshore drillers. And oddly, the thesis around the offshore drillers was, hey, you get to buy this equipment for pennies on the dollar as it's inflecting. And right now, that thesis that was applied to offshore drillers can be applied to onshore drillers, where they're actually, in some cases, cheaper on a replacement cost measure and generate much more cash flow right now at a depressed part of the cycle where activity is quite low. So as natural gas prices rise, as oil prices rise too, maybe with a lower percent change versus last year's price, but still potential upside, you could see a material increase in onshore rig count. It's much easier and much faster to bring these rigs on. That's been the bear case for oil and natural gas for the past decade. And oddly, everyone sort of forgets that when they evaluate these drilling rig stocks and some of the other services stocks. They can bring a bunch of rigs back on, not as many as they could, let's say, 5 years ago. And these rig companies trading at 20 or 30 or 40% free cash flow yields to the market cap could see massive increases in cash flow and could trade from a fifth or a sixth or a third of replacement cost up to replacement cost and maybe more. So it's that offshore thesis, but onshore in a way that frankly can work way better, way more seamlessly, way fewer issues in terms of the actual ramp, and way easier to see sort of who the incremental consumer of the incremental drilling rig and related services are. So really excited about that. Love getting this big discount to replacement cost, along with pretty high free cash flow yield, which is, I think, a very, very rare thing to get together.
And when it comes to returning capital to shareholders, particularly a lot of the bigger producers, that seems to be the trend these days. Pioneer comes to mind that pays a very large dividend, but a lot of them are paying very decent dividends, as well as buying back shares on a regular basis. Do you take that into account at all? Obviously, you were talking more focused on the small caps. I'm guessing that return of capital to shareholders is not such a big part of your thesis there. But when you're looking across the industry for investors who are maybe more focused on, dividends and share buybacks, are you seeing a lot of opportunities in the market today?
Yeah, actually, it's sort of funny that you'd say that, because some of these small producers are paying enormous dividends and engaged in enormous share buybacks. And so I think it's really hard to explain why some of them have done so poorly. Maybe they haven't grown production and investors still really want that. Maybe people really just want stocks that have 10 million or 30 million or something a day in trading volume. I'm not sure exactly, but you can see some of these producers paying out. We highlighted this, in our latest white paper and in this little webinar we put out, that multiple of these producers are returning more than 20% of their enterprise values a year in dividends and buybacks. And some of it, again, might be like special dividends rather than regular dividends, and the market doesn't reward those as well until you do them enough. But there's a lot of shareholder return potential in the small cap space, and some of them are very active. I will highlight there's one other form of shareholder return that doesn't get a lot of attention that I think should get a lot more attention, which is debt paydown. And I know it might sound weird because it's not money in your pocket, but neither really is a share repurchase, right? A share repurchase, unless you're selling your shares back to the company, it's not really money in your pocket. It's just, a reduction in the share count. Debt paydown under the Miller-Modigliani theorem should yield an equivalent return to share buybacks, at least in the short term. But we've found over time, companies going from over-levered to under-levered actually see a 2 or 3x improvement in value versus just purely paying a dividend or buying back shares. So, if you pay off $1 of debt, your market cap might actually rise over time by $2 rather than by $1 or 50 cents, or the way some people treat it, not rising at all. So then it's a really important component, and that you'll see, I think, a lot more in the smaller cap space, even than share buybacks and dividends.
And when it comes to jurisdiction, do you stick to North America? And in terms of your North American exposure, are you more heavily weighted towards the US or Canada? Are you looking at South America at all right now, or any other jurisdictions around the world?
Yeah. So we're North American focused, but we'll invest globally. We do have some exposure in South America right now. I think the shift in Colombia right now, coming with the elections soon, very promising. I think there's hopefully going to be some more political change in other parts of South America and, frankly, other parts of the world. And so we have some exposure there, but the value right now in US and then secondarily Canadian producers and services companies is so compelling that even with some exposure, and even with also great values in places like Colombia and good political shifts happening there, it's still really hard to justify moving capital outside of those markets.
Well, Josh, this has been a fantastic conversation. I learned a ton. I know the audience has as well. Tell us about Bison Interest, and if there's anywhere else you want to direct people online, feel free.
Sure. Yeah. So we run a small private investment fund focused on public equities. It's only open to accredited investors. None of this is a solicitation or anything, just for educational purposes. But if you're interested in Bison, check out bisoninterest.com. And if you're an accredited investor and are interested, you can let us know, and we can figure out if it makes sense.
Great. I'll put a link to Bison Interest below, as well as your X profile. I recommend people do follow you there as well. Thank you once again, Josh, for coming on and sharing your knowledge with the audience.
Thanks for having me on. I really appreciate it.
And thank you for joining us today. This episode is brought to you by ARC, silver, gold, osmium for all your precious metals needs. Head to arcsgo.com, contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you, and I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.